welcome once again to Captive Review's virtual series. Today, I am really pleased to welcome back our sponsors, Zurich, who have been presenting webinars with Captive Review long before we've called them virtual series. I'd like to thank Zurich for their continued support and their willingness and openness to share their insight. And should you wish to contact any of the panelists today, just get in contact with anyone from Captive Review and we'll gladly connect you. A huge amount has been spoken in the current environment about how it's affected captives, but something I think we've heard a lot less of is around optimizing a captive's balance sheet. So I'm greatly looking forward to see what the panel have to share with us today. As usual, we'd like to make this as interactive as possible. So when you think of a question you'd like to pose to the panel, can you visit our Q&A system through slido.com? So if you open a separate tab in your browser, slido.com, and use the hashtag Captive Review. So I'd like to now introduce your moderator for the day and the Global Head of Captive from Zurich, Mr. Paul Verman. Paul.
Hello, Nick.
How are you?
Good, excellent, many thanks.
Brilliant. Well, we have a huge amount to cram in today, so I would like to hand straight over to you to introduce your panel. Thank you very much.
Thank you very much for the opportunity. Hello and welcome to everybody, first of all. I'm very much pleased to welcome you to today's webinar. Today's speakers are delighted to share with you their experiences and recent market observations in the current international market environment. Therefore, let me please introduce our excellent speakers to you firstly. Christoph Betz. Christoph Betz holds a German diploma in both computer science and mathematics and is a fully qualified Swiss actuary. He joined the Zurich captive team in Switzerland in 2014 and was involved in various captive feasibility studies and also performed actuarial tasks for Luxembourg stated captive mandates. Since 2019, he is heading the captive pricing and consulting team. Derek Bridgman. Derek is currently managing director with responsibility for SRS European Risk Consulting Practice. Derek and his team provide statistical loss and exposure analysis, feasibility studies, and financial analysis for commercial insurers, captives, and other alternative risk financing structures. Derek is a regular participant on various EU panels covering topics including alternative risk financing, Solvency II, and base erosion and profit shifting. Prior to joining SRS, Derek led the international captive advisory practice at Marsh, overseeing the consultation with clients on the strategic direction for their captives, providing advice on whether a captive is an optimal risk retention vehicle to achieve the client's objectives. Holger Kraus. Holger is the head of risk financing and employee insurances at Siemens. He holds a master's degree of business administration and economics of the University of St. Gallen in Switzerland. After his graduation, he joined Aon in Zurich, Switzerland, and he is specialized in consulting clients on insurance program structuring, the establishment of captive reinsurance companies, and the optimization of their use. In 2009, Holger joined Siemens in Munich, Germany. In 2010, he was appointed as the CEO of Risicom Rückversicherung AG, the captive reinsurance company owned by Siemens and domiciled in Germany. In 2016, he was appointed head of the captive committee of the German Risk and Insurance Managers Associations. Emma Samson. Emma joined Zurich in 2001 and has since held a number of varied roles across customer and distribution management, operations, and underwriting. In 2010, she joined the UK captive service team as an underwriter and has led the team since 2017. Emma is responsible for captive fronting and other risk-sharing solutions for UK domestic customers as well as international customers. In her time at Zurich, she has worked closely with some of Zurich's largest and most complex customers with a focus on designing in delivering bespoke multi-line, multi-year captive fronting solutions, both, of course, domestically and internationally. Lars Henneberg. Lars is Vice President and Head of Risk Management at AP Møller-Mærsk, a global integrator of container logistics. He's a lawyer by background with focus on energy, transportation and logistics and insurance. From 2005 to 2010, he held the position as General Counsel at Maersk Oil, and in 2010, he assumed his current position as Head of Risk Management at AP Møller-Mærsk, as well as Managing Director of Maersk Insurance. He is a board director of 2 insurance companies. Lars has broad international experience, including a posting for Maersk Oil to the Middle East from 1999 to 2003. Wendy Lu. Wendy Lu is Zurich's global head of corporate life and pensions, called CLP, which provides employee benefits and value-added services to Zurich's commercial customers. CLP is present directly in 20 countries and, through the employee benefits network, provides cover to workers in over 140 territories. Wendy joined Zurich in 2011. She has held various positions in the employee benefit area, including heading up the Zurich Global Benefits Solutions team, which works exclusively with multinationals, and prior as Global Partnership Director, strengthening the strategic relationship with a leading global employee benefits intermediary. Before joining Zurich, Wendy was with Towers Watson for 10 years, specializing in international benefits consulting and benefits financing solution. Wendy received an MBA from Columbia University and London Business School and a bachelor's degree in mathematics and economics with a minor in accounting from UCLA. She is a fellow of the Society of Actuaries. Now, in our today's discussion, we would like to share with you our market observations, how captive owners optimize their captive balance sheets in the current market environment. As we all observe, market participants are currently faced with various market requirements. Everybody is interested to manage their contract terms and conditions as best as possible. A lot of risk managers are currently faced with increasing market premium rates, more exclusions, and a shortness of capacity in certain line of businesses. We have observed some interesting buying behavior developments in risk financing and in the underwriting appetite across the European captive owner community. In addition, we have experienced an increasing market demand for risk financing solutions compared to previous years. In this regard, I would like to mention again the results of 2 market surveys of the risk and insurance manager associations from UK and Germany, which were published last year. Both associations confirmed at the time that more than 50% of their members are exploring alternative risk transfer solutions, including starting to or increasing the use of captives for the 2020 renewals. Also, in our view, a lot of market participants have and are still exploring setting up a reinsurance captive or a protected cell captive solution. Accordingly, I can concur with the view of the 2 country associations that indeed an increasing market demand regarding the use of alternative risk financing instruments has occurred. How have existing captive owners responded to the current market requirements? Have they increased or decreased their captive net retention? Or have the insurance buying principles captive owners remained unchanged compared to former years? Christoph will now share insights with us on this. Over to you, Christoph.
Many thanks, Paul, for the kind introduction. My name is Christoph Betz, and I have the pleasure to present to you today the results of the survey that we performed together with Captive Review. Yeah, I'm working for Zurich. I'm heading the captive pricing and consulting team. So apart from the survey, we have quite some experience on our own working with captive customers and some insights how they perform. First, let me maybe remind you of the comment that Nick said in case that you will have any questions in regards of my talk or any of the other speakers, you can use this app Slider in order to send us the questions. At the end, we will have some time and try to prioritize the questions there. But first, let me give you some background about the survey, how we came actually to that. Shana, can you go? Yes, thanks. So yeah, why did we start the survey? The general topic is about what Paul just mentioned, that captive owners would like to optimize the balance sheet in the market environments. And actually, a quite good way to optimize the balance sheet for a captive is just to correspond to the current market cycles, to the current market developments. Why is that? Because when you have a captive, you have actually already a very excellent and powerful tool that you can use to ride the waves of the market developments. So if the market is going to a hard market at the moment, that means per definition that you don't have so much capacity on the traditional market, and that the capacity that you can buy on the traditional market will come with a quite high price tag. So if in that environment you use your captive to bring additional risk into your captive, taking it away from the traditional market, you can benefit from the fact that for the risk within your Zurich, you can determine the fair price tag that you see fitting in order to finance the risk, whereas on the traditional market, you might need to pay a premium that might be a bit above the pure premium that would be necessary to finance that risk. So that way you can have a more balanced view on your balance sheet between the captive and the company when you look at the overall risk. And the similar logic applies when you are in a soft market. If you are coming from a hard market to a soft market, that means that there's a lot of additional capacity on the traditional market, and you can place the risk they are quite cheap. That might be the time point when you want to bring risk out of your captive and into the traditional market, because you might get better conditions there on the traditional market than what you could finance yourself within the captive. So these are some considerations that we were looking at, and actually our hypothesis was when we looked at that this is something that our customers, our captive customers, or that captive owners in general on the market would follow. So last year we performed the internal analysis based on the Zurich captive portfolio to see if we can find any proof points that our logic is actually in practice used on the market. But what we found in our analysis was actually that the Zurich customers they do not perform such frequent adjustments to the retention. It seemed that they were reluctant with making frequent adjustments there. And at this stage, then we were wondering, okay, is it because our hypothesis, our logic, is that not really true? Are the captive owners considering other stuff than the pure market cycles that lead to the fact that they don't perform this frequent adjustments? And we wanted also to understand, is maybe our Zurich portfolio a bit different from the rest of the market? Is this not the trend that we would see at the overall market? So at this stage then, this year we were performing the survey, going out to the market together with Captive Review, putting together a set of questions to find actually proof points for our hypothesis and to get a general picture on the market. Can you go to the next slide, please, Shana? Thanks. So before we dive into the survey itself, I would like to present to you in some way the participants of the survey, the people who answered the survey. So all in all, we received about 80 responses to our questions. And the majority of the participants have been captive owners. On the top right corner, you can see the percentage breakdown of the people who responded. So the majority have been captive owners, but we received also some answers from some external working parties like brokers or consultants who work in some other way with the captives. And the majority of the people who have answered, they have actually quite some work experience with captives. About 90% of the people, they have at least 5 years of experience working with captives, and 58% of them have even experience of more than 10 years. And going forward for the next points of the analysis, we were grouping together the people who responded into basically 2 groups. On one hand, the persons who are directly involved into one specific captive, like the captive managers or captive owners. We group them together as what we call here going forward captive owners. And on the other hand, the group that is more involved into a captive which is owned by another stakeholder like brokers or consultants. These we grouped here under the name captive advisor. And the logic why we were trying to group them that way is that we might see different responses from the 2 groups. The captive owners, they have experience with their own captive, which they would answer for, and the captive advisors, they might have insights into more than one captive. So we asked them in that regards to answer actually for the typical customer or what the majority of them would have to say. Okay, let's start with the survey. Shana, can you go to the next slide? Yeah, so first I would like to present to you the result of the survey that what I call here is the perceived reality on the market. So what did the participants actually think themselves, how they bring the market cycles into consideration for the risk in the captive. So we received a quite strong picture that almost all of the participants in the survey feel prepared for the hardening market, in the sense that they feel prepared to use the captive in an efficient manner to react to the market. This picture is that basically all of the captive advisors and the vast majority of the captive owners feel prepared to use the captive in an efficient way, in an efficient manner. And when we break it then a bit more down, when we asked the 2 groups actually, okay, do you take the market cycle into account when you decide about your captive retention, when you think about how what risk do you want to have in your captive? There, from both groups, we received actually the response that the majority of them, yes, they take the market cycle into account. When we look at the captive owners, it's about 95% of the participants who say that the market cycle is affecting the retention that they have in their captive. More than half of them, like 53% of them, say that it is even like the key factor that influences the retention that they have in their captive. And for 42% of them, it is at least one factor among others who influences what risk they have in their captive. When we look at the other side, at the captive advisors, the picture there is the general trend is the same, but the picture is slightly different. So they are like 82% of them say that the market cycle is affecting the captive retention. For 2/3 of them, it is one of the factors that influences it, but not the key factor. And still 18% of them, it is even the key factor that influences the captive retention. So all in all, the picture of that says that yes, people feel prepared for using the captive in an efficient manner in the hardening market, and they take the market cycles into account. So based on that, you would actually expect that this is something that you can then see when you look at the change in the captive retention, that in some way it would follow the market cycles. So let's have a look at that. Can you go to the next slide, please? Okay, so this is what I describe here as the real reality on the market. This is the picture that we get when we ask the participants how have they reacted in the past and what are their immediate plans for the near future. So when we look at the past 10 years, from both of the groups, from the captive owners and from the captive advisors, we received the message that more than half of them, they have not changed their captive retention at all in this 10 years, or a maximum of one time. So the big majority of both groups actually, yes, they did not change or almost did not change the retention there. Well, with that, you could now argue that, okay, over the last 10 years, in the majority of the years, actually, it might not have been necessary to adapt because we have been mainly in a soft market. So if you set the retention to a reasonable amount at one stage there within this 10 years, and you feel comfortable with that, there might not be a need to readjust that afterwards. But when we look now to the near future, as Paul mentioned in his introduction, we are now in the cycle of a hardening market, and people are preparing for that. Given the answers that we saw from the last slide, you would expect now that people take the market cycle, the hardening of the market into account, and that we would see a large trend for adjusting the retention, especially given that a lot of the people have not recently changed it or have not changed it too often in the past. But again, the picture is now the same, that about half of the participants, they do not have plans now to change the retention within the next 2 years. When we look at the captive owners, we see that from the other half of them, at least the majority of them, plans changes due to the hardening of the market. So they seem to take that into account for the near future. But from the captive advisors, it's just a number of 18% who plan then to change the retention due to the market cycle, and the rest of them, the other 27%, change it for other reasons. So based on that, it seems like we have some kind of gap here between the fact that people actually would like to take the market cycle into account for adjusting the captive retention, but that there are no concrete planned actions for the near future. And also in the past, there have not been so concrete actions there. So now it would be interesting actually to close that gap. If people actually want to take the market cycle into account, but don't do it, there might be some reason behind that, maybe some challenges or some things that hold people back from adjusting the retention. So if you go to the next slide, this is where we actually ask now the participants, what challenges do they see to better understand why might it be that people are not planning now immediate changes to the captive retention. And this is a question there. Of course, we gave people more than one answer. So it's like multiple choice, because when you make a change to the retention, there will be more than one reason for that. And on the same hand, it might be also more than one reason that holds you back. And as we can see, about 9% of both groups, they don't see any challenge when they make adjustments to the retention, but the majority, more than 90%, see at least one challenge there. And some of the common reasons that we have seen, that we have learned there, are legal and regulatory challenges. One example for that might be when you adjust the retention, when you increase the risk in your captive, it will have a direct impact on the solvency capital, which then will also increase, and not necessarily in a proportional manner, but it might increase to a larger amount or non-linearly. So you need to have your captive well capitalized in order to buffer that, or you would need to pump in now additional capital. So that can be one challenge. Then another common answer that we have received is that people do not feel sufficiently prepared, or that they do not have sufficient knowledge to set to a proper retention, which might be a fair point. When you want to adjust the retention, you don't want to do it randomly, but to an amount that makes sense. Otherwise, there's not really sense in changing that. But there are experts on the market that could be asked for performing an analysis for setting a proper retention. Another reason that we have learned about is that people, they feel comfortable with the retention that they have, or that they don't see a benefit for the change. where my personal view there is that even if you feel comfortable, it might always make sense to challenge the status quo, to ask yourself, okay, a retention that I said 10 years ago under other market conditions, is that still something that is fitting today? I think it's always worth to make this, what we at Zurich call captive health checks, to see if the current retention is still proper. And then the last point that I like to highlight here is the opportunity costs. So I can't tell too much there what that means for the individual, because behind that there might stand more than one reason. Opportunity costs in general will mean that the capital that you will need to use in order to change the retention, you can use in a better way for something else. And I personally would be also curious to learn more about these reasons. What are these other better opportunities to invest the money there? Yeah, maybe we will receive some answers about that in the next talks. Can you go to the next slide, please, Shana? Okay, so the last result from the survey that I thought would be worth mentioning specifically here is how the participants actually plan to adjust the risk in the captive, because again, there might be more than just one way to do that. And the answers that we received are again in line with what we have been expecting or what we see here at Zurich. And the majority of the people see a very strong and very good leverage in direct adjustments to the captive structure via adjusting the deductibles below the captive, or via making adjustments to the PA and or the PO limit there, which affects directly the structure. This is something that we expected, and that is direct leverage. But what we find interesting was actually that also a lot of people see as a very good leverage the change between a net and a gross structure, which definitely is something that makes sense, because behind that is a very strong arbitrage potential. When you go from a net to a gross session, you have now direct access to the reinsurance market, which might be able to offer you with additional capacity and have a different pricing model. So there's a strong arbitrage potential behind that. And actually, this is also a trend that we have seen within the last 1.5 years, that we receive more and more requests for that kind. And that actually brings me now already to the summary, which is my last slide, Shana. Yeah. So what do we learn out of the survey? It actually did not contain for us further surprises after we performed the internal analysis, because it actually confirmed the picture that we have seen when we looked at our own portfolio. It more or less just confirmed what we have seen before. So we now can say that the Zurich portfolio is not off the market, but is actually in line with the general trends that we can see there. It seems that the market participants, they do not seem yet to be in a state of feeling comfortable with making the frequent adjustments to the captive. And when you look at the individual case, there will be always individual reasons that you can learn about why the captive retention was kept stable over the past. But I like to highlight here in my summary the view that a strategy that has worked in the past over the last 10 years, it might still work, but it might be of worth to challenge that, to just reassess if the same strategy is still fitting under the current market conditions, or if another strategy would make more sense now. It might pay off to be flexible. And if the reason that holds you back from making further adjustments is a lack of knowledge, then it might be worth seeking the advice from experts on the market, because there are definitely experts on the market who can help with setting a proper retention. And the final remark is then that actually I did not show all of the answers in detail here that we received from the survey. One other interesting point that we learned about is that participants might still not be in the mood of making frequent adjustments. A lot of them let us know in the answers that they actually are happy to bring in additional LOBs into the captive, which is then another way of increasing the risk that you have in the captive. And yeah, one prominent example for that might be actually employee benefit, about what we will learn at a later stage today in the webinar. With that, I like to close my talk and give back to Paul, and I think Emma and Lars.
Many thanks, Christoph, for sharing those exciting insights with us. We have heard from you that the survey shows that market participants feel prepared for a hardening market environment, but seem sometimes to be reluctant with adjustments to the captive retention. May I ask you, Emma and Lars, what trends have you experienced in the UK and in the Nordic market? Over to you, Emma and Lars, please.
Thanks, Paul. It's a pleasure to be here. So I think I'll kick off with a UK perspective. And I think, it's quite normal to see changing market cycles with pockets of hardening market appearing from time to time. What we have seen that is very different over the past 12 to 18 months, I think partly as a result of the pandemic, is that the combination of a mass hardening of the market alongside businesses across the board having to find significant savings throughout their organisations and operations, including their insurance spend. This means that self-insurance is becoming an increasingly attractive and viable option to reduce insurance costs in a way that we haven't seen before. And obviously, captives are an effective and efficient way of doing that. So the impact on the UK captive market itself has really been a flurry of activity over the past sort of 12 to 18 months. And this activity broadly falls in two buckets. The first, and I would suggest largest, relates to an increase in the number of new captive formations, particularly in the PCC space. And the second is in respect to customers who already have existing captives. Here we've seen captives being used to bridge gaps in capacity or cover. And also we've started to see a renewed interest in ensuring that the current captive structures are as efficient as possible. And some captives are looking into reviewing individual line retentions, and some are taking a more holistic view of their captive portfolio, and they're writing or looking to write new lines into the captive, for example, D&O side, B and C, A&H, and of course employee benefits, with the goal to optimise the diversification benefits and ultimately reduce the overall cost of risk to the parent. So finally, just to echo some of Christoph's comments around the growth sessions, we have seen an increasing interest, and that obviously allows captives to access the direct reinsurance markets and the potential arbitrage opportunities. I should mention at this point that these conversations can purely be exploratory in nature at this time, because often they may take more than one renewal cycle to be implemented, and that's due to the internal conversations that risk manager will need to undertake, as well as some of the regulatory considerations as well. So Lars, Maersk is the largest container shipping line and vessel operator in the world, and you purchased some incredibly complex insurance programs. You must have seen all the stages of the cycle.
Yes, absolutely, and I can confirm that we have also seen a hardening market over the past 3 years, I would say, both within marine, property and financial lines in particular, and also cyber, where we see an increasingly hardening market with some variance in when it kicked in. So it's clear that the pricing has gone up across lines, and also that we see capacity constraints. And if you are a captive owner, this is actually something that would a market that would call for increased retentions, because normally a captive philosophy would say that if the price of reinsurance is low, you buy more reinsurance, and if the price of reinsurance is high, you buy less reinsurance. But obviously you have to. It depends on whether this is a true market cycle, whether it's purely a supply and demand issue, or whether it's actually there is an underlying change of the risk that we are talking about. It's generating more claims or more severe claims. There has been a claims inflation. And in the former case, obviously, the captive should, in my view, increase its retention. And I can confirm that we have done that on those lines where we found it relevant over the past 2 years. And also in the latter case, I believe that's where you have to think twice and make certain that you truly understand the risk. I saw the point from Christoph where he said that a lot of people wouldn't do that because it would require them to hold more capital against it. And I would say, yes, it requires you definitely that the SCR goes up. But on the other hand, when you retain more risk, you also retain more liquidity within your company that you can reinvest in your business by lending it back to the business instead of paying it to the insurance market.
Okay, thanks for that insight. So let's turn our focus to Maersk Captive itself, which was formed back in 2011. So I think it's fair to say that it's changed somewhat over that time to be the entity that it is today. So let's delve a little more into that journey. What were the initial strategic objectives for the Captive when it was formed, and how have they evolved over time?
Yeah, I think that as I alluded to before, the initial objectives when we started this Captive up in 2012 was to leverage the strength of Maersk's balance sheet to retain more risk, to bring down the cost of risk and make Maersk more competitive in the market. That was the first objective. The second objective was to avoid the dollar swapping and keep the liquidity in-house such that we could recirculate it, reinvest it into our core business. And I would say that back in 2012, we initially just started up by taking a net share on our existing insurance programs where we found it relevant, and we were simply just following the leader in terms of price and terms and so on. Then in 2014, I believe that we moved from just taking net shares to also taking gross shares, which gave us access to basically ceding commissions, reinsurance markets, and do a little bit of arbitrage there. And then I think the big step that Zurich obviously have been involved in is in 2019. We decided to make Maersk Insurance a one-stop shop for all insurances in Maersk. So it was not only the big ticket items that we insured through Maersk Insurance. We took all lines of business in. We took them, insured them 100% and reinsured the part that we didn't want to retain, and that also included the employee benefits insurance. We did that to give more diversification to the portfolio and make the capital that we hold against the risk, make that work harder. That was the first objective. The second objective was really to administratively simplify our programs. We had we consolidated them into a consolidated program structure that has one renewal every year, and that is funded by one external insurer, which in this case is Zurich, and that of course means that we were able to consolidate 40 individual programs into maybe one single consolidated program structure. We also started setting the price ourselves instead of leaning towards the lead markets on our programs, and we do that in a way that is cost neutral over time, such we are not, so to say, the purpose is not for Maersk Insurance any longer to generate that profit, but it is to push the benefit of having the captive into the core business by keeping the premium as low as possible, and thereby also supporting making the business more competitive. And I think the last step that we are embarking on now together with Zurich is that we are looking at I would say structured multi-line reinsurance. We're looking at our reinsurance program where we try to optimize it from being, so to say, a pillar, a silo structure within each line of business, marine, property, casualty, so on. We now try to optimize it by bringing more capital efficiency, cost efficiency, but also bring a better sideways protection to our captive retention across the various lines of business. And we seek to do that by introducing the right mix of treaty reinsurance and also facultative reinsurance. And thereby we want to pass on the diversification benefits to the reinsurers, and we also want to access the ultimate capital providers as quickly as possible and cut out all the transaction costs in between. We know that today when you pay $1 when you have 50 cents of a claim, you have paid $1 in premium. So we want to get that. We want to get closer to, so to say, an equal relationship there. That was the journey that we have been through until now, Emma.
Okay, thanks for that, Lars. So I just wanted to explore a little bit more about the main catalyst for those changes. Were they purely external factors such as market conditions, or was it really driven by those Maersk business needs?
I think that it's a mix here. I would say that the two, I think at the strategic level, they have remained the same. It is really about bringing down, reduce the cost of risk for Maersk, and it's about reducing or keeping the liquidity in-house to reinvest them into the business. So they have, so to say, been the catalyst of the drivers through whatever we have done here. I would say that there has been a few other strategic catalysts, and one of them was, of course, that in 2018-19 we divested all our energy businesses, all our oil and gas assets, which meant that we had to restore the critical mass of the captive, and we had to restore the diversification. And we did that simply by picking up all the other lines and turned the captive into this one-stop shop that I talked about before. And then, since we weren't too comfortable with so to say what the risk reward were associated with the pricing, and we were not maybe so to say best positioned to price it at that point in time, we simply made a cost-neutral price model, saying that over time, over a rolling 5-year average, we will set the premium to be cost-neutral, obviously respecting transfer pricing requirements. So we have to keep in some minimum, I would say, profit in our pricing calculation. Another thing that we are looking at, another driver that is now playing in, is really, I would say, the flexibility of the cover. Having a captive allows you to provide cover that the market is not really is not available in the market off the shelf, and I think that that is something that we have to look into, because our risk landscape is changing, and the solutions that are available in the market do not follow as quickly as our risk landscape is changing. For instance, if you look at our enterprise risk management register, it's only 2 out of the 10 risks that are currently straightforward insurance risks, risks that can't be insured. The rest are more systemic risks, they are more network risks, and these risks we are finding looking for risk financing solution for. Currently, they are being financed through the banks, through liquidity offers, or liquidity buffers, to cash and to credit lines and so on. But obviously, we would also like to keep and make insurance relevant in this landscape. And the insurance market doesn't come up with solutions fast enough, we can use our captive to create solutions for those risks.
Okay, thank you very much for that, Lars. I think we've probably only really touched the surface of this topic in the short time that we've had, but we are unfortunately now out of time. So just a quick note to our audience again, if you do have any questions, don't forget to submit them via slido.com using the hashtag Captive Review for the Q&A session at the end of the webinar. And so with that, I'll hand back to Paul. Thank you.
Many thanks, Emma and Lars, for sharing those exciting insights. I heard that determining the right retention level for a captive is not easy, and a lot of captive owners find that challenging. Could you both, Holger and Derek, please elaborate what it takes and what you would recommend in this respect? Holger and Derek, please.
Sure. Well, I'm happy to give the captive owner, captive consultant perspective, and maybe Holger can chime in with the corporate aspect. I suppose in our experience, the captive market has probably been a little bit reactive, really, in respect of the evaluating the optimal retention level. I think simply in recent years, the market, as we've heard throughout the session, has been soft. So there's really just been availability of affordable premium, good capacity, and probably reasonable deductible levels in the main. So I just think the financial benefit has not been there. It hasn't been evident. So I think many captives, I think they've been established a number of years ago. The insurance programs have remained pretty constant in recent years. So I think ultimately
the thing has been in recent years, there probably just hasn't been that financial benefit or that from a cost of risk perspective. But I think now from a cost of risk perspective, we really are seeing clients see it as opportune time to evaluate whether, I suppose for clients who don't have captives, to evaluate whether it makes sense for a captive. As Emma spoke, there's been quite a bit of interest in protected sale captives, and really that's been seen as a way to, I suppose, grow into a wholly owned or dip your toe in the captive market. I think, as Christoph mentioned, really companies with existing captives are really seeing those as powerful tools. I think we've seen examples of companies where they were previously in runoff and have decided to exit the runoff period now due to the challenges of the hard market. And really, the benefits are coming around that, avoiding that pound swapping potentially in the primary layer, or simply just plugging gaps higher up the insurance tower. I think, as Lars mentioned, really the captives, we've seen examples, and this is true for cyber, where there's been gaps between the market and the understanding of the risk. So really the captive being used to incubate the risk and really allow the captive, or allow the insurance market to catch on. But it also helps from a client perspective, really just to understand their risk. So I think, as I mentioned, really now we're seeing quite a bit of interest in consulting. A lot of companies, self-managed companies, maybe have that day-to-day expertise in-house, but maybe from a consulting perspective, that's really where they might require a little bit of assistance to really just understand whether it makes sense to retain more risk. I think many companies really believe that the current market pricing and the capacity available is really not reflective of their individual risk. So there's opportunities potentially for arbitrage in using your captive. But I suppose in terms of whether we're looking at a captive setup or utilizing an existing captive, generally or typically the key driver is around financial benefit. That said, I think captives now are being used more and more for that strategic benefit and maybe managing volatility across business units or from a corporate level. But in terms of the process, maybe just to give a little bit of detail in terms of the process, in terms of how do we evaluate whether there is financial benefit. So typically the process we would undertake would be really, as a step one, to understand the priorities and the preferences of the captive owner and the group and the corporate group. Is there requirements around admitted policies? We mentioned earlier around legal and regulatory requirements. So is there any red lines there? What would and would not be acceptable to the client and locally to the regulator? I think understanding the risk-bearing capacity of the group. Do they have a capacity and an appetite to retain risk? So that's important to establish early. Understand the capitalization available. Obviously, we've seen draws on capitalization and cash of late through COVID. So cash is king quite often. So if we're looking at an existing captive, are we looking to optimize, but are we looking at utilizing the existing capital base of the captive, or is there an ability to increase the capitalization? And then I think it's around understanding the potential for loss. So loss analysis to understand their propensity to loss going forward. So really this can be a very detailed exercise with stochastic modeling and industry data, or quite often the company maybe has for liability type risk, maybe has a lot of historical loss data, and they feel that that's reflective of their propensity to loss going forward. So again, a loss analysis to be undertaken. And then I think it's important to work with the brokers then, and in terms of trying to understand where the premium indications or what the premium reductions would be for potentially increasing the risk, to really undertake a cost of risk analysis. So understanding your cost of risk currently, and then comparing this to alternative captive retention options. And as I say, really it's a case of the captive playing a part wherever it's financially efficient to do so. So again, that may be at the primary layers for in terms of avoiding pound or euro swapping, or potentially it's higher up in taking a quota share, looking at a quota share arrangement. I suppose ultimately it comes down to a risk-reward decision. There may be significant premiums available from the premium reductions available from the market, but on the other side, need to balance that against is it appropriate to retain that additional risk. I think one of the things we're seeing, Emma spoke around the aggregation of risk within captives, and we are really seeing many companies have built up over time they've built up captive programs with a number of risks, property and casualty, and a good mix of uncorrelated lines of risk. I think Lars mentioned around the increase in a structured reinsurance approach, and we're certainly seeing that in terms of existing captives, as I say, have been in operation for a number of years, good capital bases and a good inherent diversification of risk. So I think looking at structured reinsurance placement can be evaluated really to sort of capture that inherent diversification and manage your volatility in a more efficient way. So I suppose hopefully that gives a little bit more detail in terms of typically the process. I think it's really just understanding what is key to the client and what are those red lines and parameters that you're working, but really then providing them with a robust analysis that really aligns to their priorities and preferences. Because I think one thing is we're seeing risk managers are becoming more and more sophisticated around Solvency II, and not just in Solvency II. I think we're seeing many domiciles are implementing some form of a risk-based approach to capitalization, and companies really need to understand the risk that they are retained to see that it's financially efficient. So I think opportune time really now to evaluate it, and happy to discuss further if there's any Q&A. I'll maybe hand over to Holger, who maybe gives that context from a corporate perspective.
Yeah, maybe adding to what you said, Derek, I think what's also very important, I mean, if you think about changing the retention to really take into account all relevant perspectives from a corporate, and that is not only the captive perspective itself and what a change retention does to the captive results or volatility of captive results, but also what it does on a corporate level if the captive is consolidated. So I think it's key really to include all relevant stakeholders in the company in that kind of discussion, and to educate them about the effects any change in the retention may have on their area of responsibility. And I think maybe just to name just a few particular topics. One is really to be knowledgeable about the fundamentals of underwriting, to know how a technical price is arrived at for a certain risk, and also to make an informed decision how you price the retained risk, how aggressively you price it if you take it into the captive. For example, if you go towards the expected loss, or how much of a safety margin you want to include, because I mean, then if a loss happens, you either need to finance it in advance if you take a higher premium, or you take a more aggressive premium, and if a loss hits you, you need to finance it in the upcoming period. So to make a decision on that, and also to have an idea about what general actuarial concepts look like, what you talk about when you talk about expected loss, about quantiles, about confidence levels, and so on, so that you're able to also to lead informed discussions with brokers, underwriters, and actuarial consultants on that. Another topic I think that's very important is the regulatory side, so that you know what are the effects of the changes in retention on the solvency situation of your captive. Is it in line with the risk-bearing capacity of the captive? Would you potentially need additional capital? Is that capital available at all, or isn't it? Or could you add, as was mentioned before, other lines of business and increase the risk-taking even without significantly increasing the capital by using diversification effects? And last not least, I think also important is the accounting topic on the corporate side, because you might, especially if you expand into participating in excess layers, say in D&O or in cyber, where you don't have any diversification like a large insurer has, and the premium you will get for your participation is actually very low. Obviously, the probability of taking a loss is also very low, but if a loss occurs, it will be much higher than the premium you collected for that kind of risk. So also to make sure that any potential volatility that is caused by such a loss is being anticipated and is being accepted in case it happens, or that you are looking for kind of, for example, structured reinsurance solution to smoothen such effects. So I think it's really core not only to look at the captive itself, but also to very much look at what happens upon consolidation of the captive on the corporate level, and what are potential volatility effects there, and are they bearable and are they acceptable for the key stakeholders in the company, or aren't they? So that would be
many thanks, Holger and Derek, for your great input and feedback. May I move over to Wendy, please? Wendy, you oversee the global market dynamics in the EV Life business. Have you observed similar developments of hardening markets in your world, please?
Thanks, Paul. And in the interest of time, I'll keep it short and happy to take any questions. Employee benefits or lifeline is often viewed as a very good risk to go into the captive for diversification. In summary, in the life or employee benefits market, we are not yet seeing the impact of hardening market as much as we do in the P&C side. However, there are a few trends that we are seeing or expect to see that I would like to make note of. The first is impact from COVID. So because the impact of COVID, we are seeing temporary markets hardening in some markets. India, for example, is one market that we're seeing this effect. And also we are seeing some adjustments into the pricing, into life, disability, as well as income protection line. So this could be a general adjustment of pricing increase, or could be focused on specific factors, such as the old age cohort or specific industry, where insurers are being more, also the risk of pricing are being more selective, as well as the economic impact to the income protection coverage. The key question that we're all watching and evaluating is, would this impact that we're seeing, are they temporary pricing adjustment, or do we expect this to solidify, or in the long term to reverse? So the impact of this still remains to be seen. Some are making note that we are expecting the hardening of income protection or disability market, especially due to the rise of mental health claims. The second factor or second trend that we expect is, of course, come from the reinsurance market. With the P&C market hardening, we are seeing competition for the reinsurance market. So this could eventually lead to the life market, for the life market hardening to follow. So again, I think there's no general trend or what we can pick up as definite hardening of the life market, but we do keep a close watch on it, and there are some temporary impact that we are seeing from COVID that we need to see if they stick around or if they will reverse over the long term. So Paul, over back to you.
Many thanks, Wendy, for your explanation and the EV Life view. We are getting closer, of course, to the end, but we have received meanwhile a lot of questions, and please be assured that we will answer each and every question by email, but I will take out one question, please, which might be addressed to Lars, because he mentions this already in his presentation. So I got the question: what are for you as a captive owner the pros and cons of a net versus a gross session, and when should a captive owner net and when a gross session being chosen? Lars, would you like to comment this, please, a little bit?
Yes, I can do that. I think that obviously the net solution, where you basically take a share of a selected insurance programs and follow the leader of that program, is probably the best solution to start with, to get acquainted with the risk. As you then get more sophisticated, learn more about the risk, learn more about the market, and get more built competences in-house, I think a next step would be to, I think that the optimal step would be to move to a gross position, where you basically get access to the reinsurance market that can offer a different solution than the solutions that and also different prices. There can be arbitrage elements in between. There can be ceding commissions that you can benefit from. So I think as you get progress the journey, the captive journey, I think this is a natural position to end up in, to take more gross positions and then cover cede the risk that you don't want to retain in accordance with your strategy to the market. Obviously, you will have to live with a, so to say, counterparty risk on your reinsurance. You will also have to live with the risk that the reinsurance doesn't respond or that your reinsurance terms are not back to back. But I think if you have the right competences, these risks are manageable.
Many thanks, Lars, for your feedback and for your explanation, which is certainly helpful for our participants on this call. Conscious of time, as I said, we will respond to each and every question which we have received. We will do so. Today's webinar has provided insights from various market participants how captive owners manage to optimize the captive balance sheet in the current market environment. To get the captive balance sheet optimized is a challenging task which requires a comprehensive expertise and experience. In this regard, I'm convinced that a close collaboration between captive owners, captive consultants, and insurance fronters is very helpful. We at Zurich will stay at your disposal. Thank you very much for your interest, and many thanks for Captive Review who made this webinar happen. I wish you a very nice evening. Thank you very much.